Let's get this new information, though. How about this for a prediction? A market crash coming in the third quarter of this year, and the U.S. is headed for bankruptcy?
That's how Harry Dent I was so taken aback.
Yeah.
That's how Harry Dent of HS Dent Investment Management says, Happy New Year. He is the author of The Great Crash Ahead, Strategies for a World Turned Upside Down. Harry, come on, man. I mean, you've seen those guys on ESPN say, come on, man. That seems a little bit over the top, doesn't it?
How many crashes have we seen in the last 10 years or so? 2000, 2002, bubble crash. 2007, bubble crash. We're getting a bubble and crash about every 4 or 5 years. So this is what we have when you go over a demographic cliff. Remember Japan. Think back at Japan. Japan went over the demographic cliff, peak in baby boom spending, peak real estate boom. They had a bust. Guess what? 22 years later, real estate is still down over 60%, still drifting down. Stocks are down nearly 80%, not that far up their lows. They keep bubbling up and then going down to new lows. So this is the new normal, given that baby boomers are aging and the next generation is not only not in the workforce yet largely, but they're not as large when they do. So we're never going to see real estate prices at these levels again, and we're not going to see stocks at the levels we saw in 2007 for a long time. So to me, this is not unusual
Harry,
at all.
You know, you're looking at the demographic changes, and certainly that is a big sort of, determinant. But what about the determinant of Ben and Mario? What about the fact that we've got all this free money in the market? There are very few alternatives to U.S. equities. What about the fact that you've got so much money globally looking for a home? Early in the year, you had 401ks, pension funds. This market feels like it wants to go higher. So what do you have to say about all these positives? Not to mention the fact that underlying economics, not so bad. You've got a housing market that has turned. You've got an enormous amount of cash on balance sheets.
China's looking better. Europe maybe not as bad.
Well, Europe, I don't know about that, but...
Well, we call this the economy in a coma. Basically, without these trillions of dollars of stimulus, we would be in a downturn, in a depression, because we also have $42 trillion in private debt, the greatest debt bubble in history, and that needs to unwind. Basically, Ben Bernanke and the economists are just saying we're just not going to let this slowdown happen. We're not going to let this debt deleverage. If you don't let your debt deleverage, if you don't restructure debt, and this is the same thing Japan's done, they've done quantitative easing forever, you never come out of this because the debt keeps weighing on the economy. So not only do you have slowing demographics, we got a 200 to 300 pound weight on our back, and you just can't run very fast. So yeah, we get 2% growth with massive life support. We're in the emergency room on life support only because of this trillions of dollars of stimulus. I guarantee
so what's the catalyst?
both of
what's
you,
the catalyst?
you take away this stimulus for 1 year, and this economy dies.
So Harry, stay right there. We want to get to Phil LeBeau because we got breaking news. We want to get to it on Boeing. Phil, over to you.
Maria, we've heard from the NTSB. We were expecting an update from them. They have at least an initial report regarding the fire investigation of that 787 Dreamliner in Boston yesterday. The NTSB saying that they have decided they're going to send 2 more investigators to look at the Dreamliner in question, and that at least initially, taking a look at the fire in question, they found severe fire damage to the battery of the auxiliary power unit. Now, remember, the auxiliary power unit is what is used to provide power to an airplane when it is parked on the tarmac. It is not while it is in flight. So the battery unit, severe fire damage there, and it's pretty clear, Scott and Maria, that we are going to see more airlines. If they haven't already, they're going to start checking the wiring on their battery units. I just talked with the folks with ANA out of Japan. They have a number of Dreamliners. They checked theirs overnight at the urging of the transportation of the Ministry of Transportation in Japan. I just talked with United Airlines. It has checked the battery power wiring on all of its Dreamliners, all 6 of them. The Wall Street Journal reports that one of them did not have the wiring done properly. So that's clearly where the investigation is headed regarding those Dreamliners and the fire that we saw yesterday in Boston. Guys, back to you.
All right, Phil, thanks so much. Phil LeBeau with the latest there. We'll certainly keep watching that story. Boeing's had a dreadful couple of days as a result of all of this and has traded already more than 2 times its average daily volume as a result of these negative stories. Harry, thanks for your patience. What was your prediction for stocks for the year 2012?
Basically, we thought they'd probably peak around mid-year. Now, they did not. We got QE3. We think markets are going to go up for a while. I think Maria's right. The market wants to go up. We'll see one more correction into this second fiscal cliff. I think we'll see another rally into maybe March, April, May or something.
What gets us that next leg?
What takes we get another crash?
What takes us up another 1,000 points on the Dow?
I think it's just basically you've had strong stimulus. You got QE3, $1 trillion over the next year committed to. That's being questioned now, but at least the next year we're going to see that. I think you're going to see Europe come back a little bit. I think you're just going to see China do better. We actually think the U.S. economy is going to slow a bit in the first quarter. That's what our leading indicators say. I think it's going to be a choppy rally, up, down, with the upward bias. It's the second half that we think a crash starts, that just like the last crash, lasts about a year and a half or so, goes into late 2014, early 2015. We get a slight new high in the Dow this year, and then we get a slight new low in the next crash. That's been the pattern. Higher highs in each bubble, slightly lower lows in each crash. Again, this should not be something that people go, oh my gosh, how could this happen? It's been happening since 1995. Bubble crash, bubble crash, bubble crash. Because stimulus doesn't last.
We want to talk, let's say your scenario materializes. We want to talk about how to protect yourself and what sectors or stocks out there might be immune to that, if any. But stay with us, Harry. I want to get your reaction to the outlook in today's Closing Bell Exchange. Joining the conversation right now, we've got Ed Butowski from Chapwood Investments, Carol Roth, author of The Entrepreneur Equation, and our own Rick Santelli. Good to see you. You heard Harry in terms of expectations of a huge crash. Ed, what do you say about that?
Well, I don't know. I mean, Harry's philosophy and his thought process, I agree with. It's just, it's very difficult for the timing. I don't see a huge crash coming. I do say that, you asked what is the stimulus for markets going higher. You'll start seeing exactly what Harry said, a stronger worldwide economy. The United States, the best thing that's going to happen in the United States is we're not going to see terrible earnings right now. But the thing to watch, Maria, is the 10-year Treasury. When the 10-year Treasury starts to gain momentum in terms of rates rising, you'll actually see the stock market do well. But at some point, after about another 150 to 200 basis points on the 10-year Treasury rising, we'll start seeing valuations stretch. And that's going to happen towards the second half of the year. So I agree we're going to have a rough market towards the second half of the year based on what we know now. But do I agree with Harry that the world's going to come to an end this year? Harry, it's just not going to happen.
Rick, what's the line in the sand then for Treasury rates to rise? I mean, is 2%, is that what you guys are talking about on the floor of the CME as the number that's going to push money into equities from the bond market?
No, I think it would be closer to 2.5%. I still am in doubt whether we're going to spend a significant time over 2%, but I would think 2.5% is the area to pay closest attention to. And to jump into this conversation on interest rates, I would probably say that some of the issues of how the Fed has managed to keep mortgage rates low, how they've managed to help the stock market go up, how they've managed to immerse themselves in housing, how we finance housing through zombies in the form of Fannie and Freddie. See, what Harry's saying and what our last guest said, I agree with everything. I think there are huge structural issues we're very dishonest about, and we whitewash it all because stocks are going up. It's just the time frame of what happens when that unravels. I think it's a long process, and I think Japan is the example of that.
Well, Carol, what's your take on this? I mean, let's say we've got a slow, anemic economy. You've got some of these issues around the dysfunction in Washington. Do you put credence into Harry's call that we're going to see a crash second half of the year?
I'm in agreement with what Rick said. I do think that structurally we have problems. I just don't agree with the time frame. I think that this is going to take a long time to play out in the system. I don't see a massive bubble and a catalyst for that bubble bursting. What I do see is that we've got companies who have a perception now of certainty, even though there really isn't any, but they will probably be putting some capital back to work that's been amassed on their balance sheets. We have consumers who have been deleveraging, so they have some credit to spend. So I think that we're going to see things going up and getting more frothy before we end up seeing a crash. So I do think that there is something down the road, but I certainly don't see it in the third quarter.
Harry, what's the biggest risk then to your forecast? What could prove you ultimately wrong?
Well, again, it's stimulus. The government keeps upping the ante. Europe and here, China, Japan, everywhere, England. But the thing is, what we've seen in the past, especially in Japan, we always look back at Japan. Same things are happening here as Japan on an 11-year lag. Booms, bust. And we do have another bubble in stocks. Stocks have already gone up faster in 4 years than they did in 5 years in the last bubble that crashed. The last bubble crashed because of the subprime crisis in the U.S. That was 4 states. Spain and Greece are as big in population as those 4 states, and Spain has a much bigger real estate bubble bursting than we do. That's all it would take to trigger the next crash.
Well, they say don't fight the Fed. Yeah,
I don't want to know what triggers the crash. I want to know what proves you're wrong. What makes it that your prediction is wrong?
Why is he going to tell you? He's expecting a crash.
I mean, I got to add this. The stock market does not have. We do not have a bubble in the stock market. That's what I don't agree with, Harry. We will at some point when the 10-year Treasury rises. This is not like 2002 to 2007. Are you blind?
But look, Harry, I'm far from blind. We're not that far from historical averages. This is more of a bubble,
and it's all artificial. That was at least partially real. This is artificially without the Fed.
Here's what's not artificial.
Let me finish my point.
Harry, here's what's not artificial. $3.6 trillion in cash on balance sheets of the S&P 500. Here's what's not official. Corporate profits that actually have been the result of companies. Wait a second. Companies shedding assets, cutting down, becoming lean and mean after the 2008 crisis. That's not artificial. That's real business, real profits, and real cold cash.
I need to finish my point.
$42 trillion in debt, which doubled in 8 years under George Bush. That debt started to deleverage, and the Fed stopped it. Until you bring $42 trillion back down to levels like we've done in every austerity crisis in history, you can't grow very fast again. Japan will never grow fast again because they have not deleveraged their debt, and we're going in the same direction.
Well, the debt. I agree with you on the debt. And by the way, the debt's only gotten worse under President Obama. That's for sure. And by the way, it's going higher. They're expecting $22 trillion in debt in the next 8 years. Thanks, everybody.
Please let me
make your final point. Make your final point.
10 years,
I got to make my point here.
Yeah, make your final point.
Make your point.
Okay, the point I'm trying to make is that when you say, am I blind, what I'm saying is I'm not blind to it. The bottom line is that stocks right now, based on expected earnings from research analysts across the street, Harry, we are 15% undervalued, and we should be about 10 to 15% overvalued. So right now, I believe we're undervalued. There's no bubble right now in terms of earnings expectations.
What did expected earnings look like in 2007 in the United States? What did they look like in 1989 in Japan? They look great until they crash.
All right, good. That's the last word, because we're going to leave it there.
I don't know why we should be overvalued, by the way. Fundamentals are not so great. All right, thanks, everybody. We appreciate your time.